Welcome back to our Singapore versus Dubai comparison series. In part 1, we covered company formation processes, business account realities, and market positioning. Today in part 2, we'll explore tax frameworks, operational costs, and long-term strategic considerations that could impact your business for years to come. Hi, I'm Ben from Statrys. Let's pick up where we left off. Now let's look at taxation in Singapore, an area where clarity matters. Singapore applies a flat corporate tax rate of 17% on chargeable profits. That's your taxable income after deductions. For new companies, there are generous startup exemptions designed to ease the burden in your first 3 years. Here's how it works. 75% exemption on the first 100,000 Singapore dollars of profit, 50% exemption on the next 100,000 Singapore dollars. This effectively lowers the rate to about 4.25% and 8.5% on the next 100,000 Singapore dollars. Any profit above 200,000 Singapore dollars is taxed at the full 17%. Singapore also operates on a territorial tax system. Companies are generally taxed only on income sourced in Singapore. Certain foreign-sourced income can qualify for exemptions if specific conditions are met. One important concept here is tax residency. A company is considered a tax resident if its control and management, meaning where strategic decisions are made, takes place in Singapore. If eligible, non-resident companies pay tax only on Singapore-sourced income. Resident companies pay tax on their profits, but also enjoy benefits that non-residents don't, including the startup exemptions, access to Singapore's extensive network of double tax treaties, and exemptions on qualifying foreign-sourced income. Put simply, Singapore's headline rate is 17%, but most new companies enjoy much lower effective rates in their early years. Its territorial system and tax residency rules make it especially efficient for international entrepreneurs who structure their operations thoughtfully. Now looking at Dubai, its taxation landscape has undergone significant changes recently. It historically attracted entrepreneurs with its tax-free status, but new regulations have created a more complex environment. Free zone companies can still achieve 0% corporate taxation, but only when they satisfy economic substance requirements, essentially demonstrating legitimate business operations within the zone through local staff, physical offices, or key management decisions made locally. Companies that fail to meet these substance requirements are taxed at the standard 9% corporate tax rate applied to mainland businesses. Mainland companies, those operating outside free zones across the broader UAE, follow clear rules. Profits exceeding 375,000 dirhams, approximately 102,000 US dollars, are taxed at 9%. Personal income remains untaxed, but most commercial transactions carry a 5% value-added tax. Here's the critical point. Dubai's tax regulations continue evolving. Economic substance requirements are becoming stricter, and the overall framework will likely see ongoing modifications. The fundamental difference is predictability. Singapore's tax system is well established and highly stable. Dubai's framework is newer and subject to regular changes. If you prioritize certainty, Singapore has the advantage. If you're pursuing potentially lower taxes and can meet the substance requirements, Dubai's free zones might be attractive. Now let's discuss practical costs for entrepreneurs planning to live and operate their business locally. Singapore carries premium pricing. For small companies, office rental rates typically range from about 8,000 to 20,000 Singapore dollars per month. That's roughly 6,000 to 15,000 US dollars, depending on the location and size of the space. Prime areas like Marina Bay and the Central Business District command higher rents, around 12 to 15 Singapore dollars per square foot per month. Suburban or fringe locations offer more affordable options, sometimes below 5 Singaporean dollars per square foot. Employee salaries in Singapore run about 20 to 30% higher than comparable regional markets, reflecting the country's competitive talent environment and higher cost of living. The upside? Singapore offers world-class infrastructure, excellent logistics networks, and a time zone perfectly aligned for Asian commerce. Dubai presents diverse cost dynamics. Free zone office rentals can start as low as 20,000 dirhams per year, which is about 5,400 US dollars for basic service packages in certain zones, but can climb into the hundreds of thousands, even several million dirhams annually, which is over 800,000 US dollars, for larger premium-grade offices in hubs like DIFC. This wide spectrum means small startups and established companies can both find options that match their needs. Employee costs also come with an administrative layer. Salaries are competitive, but every hire requires a visa, adding recurring compliance and processing expenses of around 3,000 to 10,000 dirhams per employee annually, approximately 800 to 2,700 US dollars. Like Singapore, Dubai offers excellent logistics infrastructure and strategic positioning as a global trade hub. However, businesses must manage ongoing administrative requirements and visa processes, which can take notable operational time and resources. In summary, both cities provide outstanding connectivity and infrastructure, but come with different challenges. Singapore tends to involve higher direct costs, especially for office space and salaries, while Dubai requires more administrative management, particularly if you plan active local operations involving staff visas. Singapore is leaning into its reputation as a global innovation hub. Continued investments in technology, sustainability, and digital infrastructure support its long-term goal, attracting high-growth startups and multinational headquarters. Its policy stability and strong intellectual property protection makes it a strategic base for businesses targeting ASEAN and global markets. Dubai is developing its identity as a global center for innovation, commerce, and emerging technologies. Substantial investments in cryptocurrency, blockchain, and digital finance, combined with aggressive business development policies, support its growth as an international commercial hub. However, the regulatory landscape keeps evolving, creating both new opportunities and planning uncertainties for long-term strategy. So how do you choose between these two options? Select Singapore if your primary focus involves Southeast Asian markets, or if you're building a tech or innovation-driven business. It's the superior choice when you need reliable business account relationships, regulatory consistency, and established financial infrastructure. Singapore makes sense if you value predictable compliance processes, long-term legal stability, and startup-friendly tax exemptions. Select Dubai if you're targeting the Middle East and North Africa. It's the better option when rapid setup and potential tax benefits are priorities, or when your business model centers on logistics, trading, or international operations. Dubai works well if you can handle evolving regulations and prefer administrative flexibility over rigid compliance structures. At Statrys, we help entrepreneurs with Singapore company incorporation, business account opening, and ongoing compliance management. We recognize the obstacles foreign business owners encounter with traditional financial institutions. Our multi-currency business account solutions are designed specifically for businesses operating across multiple regions and currencies. Ready to explore Singapore incorporation for your business? Visit Statrys.com and click Get Started to begin. For questions, contact us through live chat, WhatsApp, or email us at support@statrys.com. Thanks for watching.